Ladies and gentlemen, welcome to the quarterly webcast for Cadence Capital Limited. I'd like to go through a summary of the annual general meeting and an update for the quarter for Cadence Capital Limited. In our recent AGM, we showed our investors that the market for the previous year had risen 50%, and in the most recent year, the market has tracked sideways for almost a year. I guess in that sense, as we indicated at our annual general meeting last year, we're still halfway between the point of maximum pessimism and maximum optimism in recent history. In the following slide on the AGM, we illustrated to our shareholders how we exited from the market during the period commonly referred to as a global financial crisis, and then accumulated in our positions and re-entered the market starting in about March, April of 2009. That has served the fund well and has also come at a time when the market has seen dramatic recovery. More recently, the fund has reduced its exposure to the overall market. Our fund performance for our 5-year anniversary, and now almost 61 months, is illustrated in the following slide and shows that we have outperformed the market over a 5-year period. But also an interesting point on that slide is that the All Ords Accumulation Index, or our Australian market here, is up only around 4.5% to 5% per annum over that 5-year period. Now that really is a very, very lackluster performance by any equity markets. We would expect the equity market over the longer term to hopefully return in the order of 10 to 12%, and we're going to be making an effort to outperform that number. Our 5-year anniversary has come about, and we've also commissioned a rating by the Zenith agency, and we're fortunate enough to have received a recommended rating from the Zenith agency, and we will be providing that to our shareholders in due course. In spite of the fact that we've had a good 5 years and that and we've seen the markets recover to some extent, the one negative feature of the listed vehicle at the moment is that it is trading at a discount to NTA. And we've spent a number of slides here going into what that discount means and how it has come about. The following slide illustrates how the discount to NTA actually at one stage blew out to 40% and is again now contracting, and more recently over recent trading days has contracted again. The following slide also illustrates the number of dividends that we've paid out since listing, both as ordinary dividends and special dividends, and in addition we've grossed those numbers up to illustrate the taxed and untaxed, or franked and unfranked component of those dividends. I think you can see from that slide that we've paid out 32 cents of grossed up dividends during the period since we've been listed. What I've tried to finally illustrate, comparing our performance with our discount to NTA and the dividends that we've paid out over that 5-year period, is that the discount to NTA in effect creates an opportunity for incoming investors or investors looking to invest additional funds into the listed vehicle. The illustration being that if we have $1.20 of assets and we've, say, performed 10% on those assets, the assets go up by 12 cents. With the share price trading at 90 cents, you would earn a return of 12 cents on 90 cents, which obviously is a significantly higher return than 10%. Were we then to hypothesize that the discount to NTA were to contract by a margin in addition to the 12 cents that we've earned, the return on the share price would be significantly greater than the return on the net tangible asset backing. And in that sense, I've described that share chart there as an opportunity. There's been quite a few comments by shareholders in relation to discount to NTA. In summary, what we've tried to do, we've rated the fund now with Zenith and have been lucky enough to receive a recommended rating. We're providing quarterly webcasts to our shareholders so that they have some clearer indication of how the fund is performing. We've been very transparent in our shareholdings and the portfolio as a whole. And we have participated in a number of television shows, industry seminars, and we've continued with our dividend payout policy. I personally have increased my stake in the business to illustrate that as a director, having confidence in the NTA and performance of the NTA, I'm happy to buy more shares. And we've also implemented an on-market buyback. We hope that all these measures will significantly reduce the discount to NTA. The following slide shows our current sector exposure, and I think you can see from that chart that we are invested quite heavily into materials, banks, the software and services sector, as well as the telecommunications services and diversified financial services sectors. We actually underperformed this year in the transportation sectors and also in the utilities sector. Breaking that sector analysis down into stocks, the stocks that have performed really well for us this year are Reckon, RHD, Rio, Dioro, which has now been taken over by Avoca, Customers, TPM, Niqui Platinum, MacArthur Coal, and Macmillan Shakespeare. Stocks that have underperformed in the portfolio during that period include Bravura and Transurban Limited. Our current top 10 positions are listed on the following slide. The biggest position in our portfolio is RHG, and I intend to give a little bit of detail on that position. Reckon, Bravura, Macmillan Shakespeare, Illumina, Cape Lambert Rio, MacArthur Coal, National Australia Bank and First Folios are amongst our biggest holdings. During the period since the full year results of the 30th of June 2009 and 2010, and today, we have had the RHG AGM, and that AGM this year was a significant event. We've always felt that RHG is traded at a discount to net tangible asset backing, and more importantly, at a discount to cash in the bank. In addition, it's traded on extremely low price earnings multiples. Management of that company came out during the AGM and indicated that they intend to return 88 cents of cash per share to shareholders, with an additional 30 cents of franking attached to that dividend return. In effect, that creates a value of about $1.18 to shareholders before tax. The share price this month has risen significantly as a consequence of that AGM announcement, and we feel that the position has a good chance of performing even better going forward. We've put out a special notice in relation to this RHG announcement and the effect that it has on our NTA, and I would encourage our shareholders to look that announcement up on the ASX or via our website. Amongst other things, that announcement has the potential to accumulate 6 cents of franking per share for Cadence Capital Limited shareholders. In summary, the outlook for the year ahead: bottom-up stock-by-stock analysis combined with the pyramiding into positions that we consistently try to illustrate to our shareholders has worked well for the fund this year. Last year we indicated at our AGM that volatility and extreme valuation levels would be a characteristic of the market and that they would create opportunities as long as we were patient. Now, patience should again be rewarded this year. The year ahead will be characterized by companies with strong business models and strong recurring earnings performing well, and companies of a less cyclical nature performing well, and conversely, companies with poor business models, earnings of a cyclical nature, or earnings that are vulnerable to extreme changes in, say, the Australian dollar, or businesses that are extremely cyclical, experiencing some headwinds. I've already mentioned the Australian dollar, but the increasing interest rates as well as the strong Australian dollar will also create challenges and opportunities. I guess in between the lines on those three comments, we are trying to keep one eye on inflationary pressures that the financial commentators are saying does not exist in the economy at the moment, but we are a little bit concerned about a strong dollar, an increase in interest rates, and in effect businesses that have pricing power and those that, as compared to those that do not have pricing power. Businesses with pricing power in the next few years will be in a much better position than those that are simply price takers. In summary, we are reasonably happy with our portfolio at the moment and remain confident about the year ahead. Ladies and gentlemen, thank you very much again for watching this quarterly webcast, and at any stage if anyone has any questions or comments in relation to this webcast or any other feature of our business, please feel free to contact us via telephone or via email. Our contact details are all available on the website. Thank you very much.